Welcome to the Lend Academy podcast, episode number 110. This is your host, Peter Renton, co-founder of Lend It and founder of Lend Academy. Today's show is sponsored by Wonder Capital. They're an online investment platform that allows individual accredited investors, as well as institutions, to invest in commercial scale solar energy projects across the United States. You can earn up to 8.5% annually. And of course, you're also investing in green energy, which is helping curb pollution and combat climate change. You can begin with as little as $1,000. And best of all, there are no investor fees. So if you're interested, go to www.wondercapital.com/lendacademy and you can find out more. Today on the show, I'm delighted to welcome Ben Miller. He is the CEO and co-founder of Fundrise. Now, I've been wanting to get Ben on the show for quite some time because Fundrise are one of the true pioneers in the marketplace lending space for real estate. They were doing real estate deals when pretty much every other platform wasn't even in existence, and they really are a true pioneer. So I wanted to get Ben on the show. We talk a lot about what Fundrise does, what makes them different, this unique focus they have on non-accredited individual investors. So we talk about how they're able to do that, talk about how they source deals. We also talk about the recent equity fundraise, which they also did in a unique way. It was a fascinating interview, and I hope you enjoy the show. Welcome to the podcast, Ben.
Thanks for having me.
Okay, so let's get started by giving the listeners a little bit of background about yourself, what you've done in your career, prior to starting Fundrise.
Well, prior to Fundrise, right before I was working at and president of a real estate development company in Washington, D.C., we were, let's say, one of the largest retail mixed-use developers in the city. We built complex, fairly large-scale real estate projects, usually 250,000 square feet to 1 million square feet. So in an urban context, that can be pretty large. Mm-hmm. And before that, I actually worked at a tech startup and a private equity fund. So my background's been real estate, private equity tech since the late 90s, actually. Okay. And so then you started in real estate, and obviously, Fundrise has been around for a long time. I think you're one of the oldest companies in the real estate space when it comes to the online space. Anyway, so tell us about sort of what the idea for Fundrise and how you got started. Yeah. So as I said, we had these large real estate projects, and so we had large private equity or private capital partners. And in 2008 and 2009, when the financial markets blew up, so did they.
Right.
And the last thing I expected was a sort of multi-billion-dollar, fund partners to be the ones that had no money.
Right.
And so we spent a couple of years restructuring those deals. We bought some of them from the partners. It was a pretty hairy period, and I came out of it being like, okay, well, I don't want to do that again.
Right.
And thinking about the system, thinking about the capital markets, because as a real estate guy, I was really just thinking about the real estate. I never really thought about sort of where does money come from? How does the money get into my projects? Why does it exist the way it does? And one day I was doing a small scale real estate deal in the kind of emerging market of DC. My brother and I were sort of like local developers here, and it sort of dawned on me, like, well, what if we use the internet to raise the money for this deal as opposed to traditional? And this was before the Jobs Act, before any idea. This is like the history of the first real estate crowdfunding deal is 2011, and we're sitting there trying to convince the SEC to let us do an online offering of a single real estate deal for $100 a share. And they were sort of like, what are you talking about? This is crazy. This idea of internet fundraising, or I called it online syndication, was just this totally, outrageous idea. People thought it was crazy. I would go to real estate companies and say, you should do this. And they said, that's crazy. We're never going to do that.
Right.
And then by 2013, they started saying, well, that's not crazy. That's just novel. That's novel. And by 2014, 2015, people started saying, well, that's obvious.
Right, right. So yeah, people came around eventually. So when did you actually do that very first deal? When did it close?
Well, we were the real estate company. We were this, we built a web platform, and then we got the securities side of the business all teed up together. So we bought the real estate in 2012 is when we did the offering. 2012 is when we launched it. It was a property single. We raised $325,000 for 175 people, and I think it took us 4 months to do that.
Wow.
So I was like, oh my God! At the end of that, I was like, that was man, that couldn't have been worth it. And now we raised that like less than a day.
Right.
We probably raised $500,000, $1 million a day at this point. So it's like there's a nonlinear nature to the tech that's different than real estate. Real estate guys thought I was joking when I told them how much time and effort I put in to raise $325,000.
Right. Yeah. Well, there's certainly easier ways to have done that, but you really have been a pioneer. I mean, you're trying to get this done. So you closed this deal then after the Jobs Act, or were you trying to do this before?
Before. We did it before. We cleared it. We filed it with the SEC, I think in 2011.
Right.
But we didn't get cleared. It took us it might have taken us like a year. I can't remember exactly, like maybe 8, 9 months to get cleared by the SEC because they were critically skeptical of it when they first saw it. We actually hired a former deputy director at SEC to help us shepherd it through the SEC, so that helped us with some credibility. And so then right when we're doing this, all of a sudden the Jobs Act comes out of, for people who were there, it really came out of nowhere. I mean, to me it was just, it hit the House and the Senate, and it flew through the House. I remember going up to the Hill trying to tell people that this was a good idea. And, I remember people were just like, wow, something happened that was bipartisan and quick. It's like unheard of. So that was 2012 is when we sort of closed the deal. And right then the Jobs Act, got passed, but it didn't get promulgated or effectuated for a number of years thereafter.
Right. So I'm curious, you spent all this effort raising $325,000, and you decided to do it again. So clearly you must have been, pretty passionate, I imagine, about this. Was this all about trying to democratize your investor base because of what happened to you in the financial crisis, or was this something that you just felt really strongly that this was an idea whose time had come?
Yes. So one thing that we focused on from the beginning, and at times people thought we were a little bit evangelical, is we always wanted to be to the full public, to the non-accredited investor too. The idea that, so we after we did this, and it took a few years for the industry to catch on, but there's probably 100 real estate crowdfunding sites now, and I would say 97 of them all do accredited high net worth institutional money.
Yep.
We've always been focused on the individual, the average investor, the everyday guy who generally doesn't get access to good investments because that's just not the way the system's built. And that made it a lot harder. I mean, we got the regulatory burden associated with doing this was, it's 100 times harder than doing just for normal high net worth accredited investors. There's a saying in the securities world. They say that you either qualify the investor or you qualify the offering. And so most sites qualify the investor. You have to be a qualified or accredited investor. We always qualify the offerings, and so then anybody can invest in them.
Right. So was your first offering a non-accredited investor?
Yeah, public.
It was.
Yep.
Wow, that's amazing.
That's why it was so hard.
That's amazing. So, okay, then.
It might have been the smallest public offering in history.
Yeah, certainly for a long time. Yes. Okay, then let's just talk a little bit about how you obviously now you've established your business. How has your company evolved since those early days? What's actually stayed the same, and what has changed?
Oh my goodness! I mean, we've been doing this for now 5 years, So it's evolved a lot. We started out doing these individual deals, and then investors could come on the site and invest in individual deals. But there was sort of twofold challenge we found with that was that the regulatory burden for allowing the public to invest in an individual deal was just sort of asymmetric. It just made sense to create more targeted portfolios. Mm-hmm. And second is that a lot of investors, well, there's a lot of investors, like 99% of investors, they're not real estate experts. They're spent now 18 years in real estate, and you're asking a lot of somebody to look at a real estate deal and really know the difference between a good one and one that maybe is not so good. So we try to make it a little simpler and more diversified. So we moved from individual deals to these what we call e-REITs, which are portfolios of real estate that get at the fundamental advantage of going through our system is that as a public investor, as an everyday investor, you cannot get to the private market at private pricing. You only can get to the public markets, and public pricing is generally a lot higher for the same asset. It can be 20, 30, 50, 100% higher because the public markets, you have a million or tens of millions of people competing for the same purchase. It's way more efficient, way more transparent, and that results in basically higher pricing and way more liquid. And it's one of the reasons why Lending Club and Prosper were successful early on, is it basically allowed an individual to transact in a private context, but as a public investor. And so those yields didn't get bid down. They eventually got bid down by the institutional investor. So they essentially became essentially accepted by the public market. And it's not a very deep space. The Lending Club and Prosper sort of hit ceilings on how much they could put out at and keep their credit quality. So one of the big values is being able to, as a public investor, invest in private assets at the same price, at the same basis, the same terms as an institutional investor, as a billion-dollar fund.
Right, got it. Okay, so let's talk about the actual deals that you're doing. So, what part of the real estate market are you focused on, and what part geographically, and sort of what component, what sort of sub-asset class are you focused on?
Well, we sort of our approach has always been to be in the space that's too small for institutional investors and too big for individual investors. So individual, if you're going to raise money for a real estate deal, if you're an individual, you're going to have a hard time raising more than a few $1 million. Typically it's 1, 2, 3 million is friends and family. Above 1 or 2 million or 3 million, you start needing institutional money. Institutional money doesn't like to write checks. Usually they don't like to write checks less than 10 million. Sometimes it's 20. So we try to stay between, $3 to $15 million check size, which is kind of an inefficient part of the marketplace for real estate. And then we just play all over the capital stack. We just love to go where institutions don't want to go, because second institutions are there, big funds are there. It's going to price way lower. We've already seen some of our early kind of niches, where we used to get a 14% interest rate from a mezz position on an apartment building. But now the institutions are playing a lot more in, for example, construction mezz. Those yields are now maybe down to 12. So they just compress the returns. So we always want to have to be ahead of the big guys, because they just crush your returns. Right.
So in that, you sort of said 3 to 15 million range. So these are primarily office buildings then? Are they, multi-family apartment complexes? What are the actual typical kinds of properties?
Yeah, we've been doing primarily residential. It's apartments, it's housing. I haven't been very bullish on office for years. I've done office as a developer. I don't like office as a product, but and just the housing side of the market, residential apartments, there's a lot more stability there, and there's a lot of small or medium-sized apartment buildings. So we've done equity in sort of these what they call them Class B, kind of boring but really good assets where you can buy. We did a deal in Jacksonville, and we're into it for $40,000 a door, a unit, and we did some value add, maybe took it to $60,000 a door, and you can't build in Jacksonville for less than $120,000 an apartment unit, right? So you're half the replacement costs. Our current yield was like 8%, and we think it appreciates some more. That's a great way to do real estate because you can get the sort of inflation protection of buying an asset below its true cost, below its cost to replace it, and you can get the current cash flow from the rents. So, and we've done that, now for 5 years at Fundrise.
Okay, so then, are you always investing in the equity piece though? You're not investing, you're not providing, lending capital.
No, we do up and down the capital stack.
Okay,
so that might be. We do a lot of senior lending on housing. We do a lot of mezz or preferred equity, which is like a, senior to equity, but junior to debt for different kinds of apartment projects. I would say about two-thirds to half of our business has been debt. And it just depends a lot on the ground up underwriting. I mean, it's right. Everything we do is ground up.
Mm-hmm. Okay, so then how are you sourcing these deals? Where are you finding these properties?
It used to be, back in 2013, 14, there was a dearth of capital, so that there was not enough money in the market, and there was a lot of deals. And we had, we used to get thousands of deals to our site, and we, pick one or two out of every, probably hundreds. These days we have built out more traditional network where we're in markets sourcing deals a lot through the traditional ways and try to just be in the market at slightly below the institutional players' radar. And so we have 50 people now at the company. So we have a team of people who all they do is source and underwrite real estate deals.
Right. Okay. So then I want to just clarify something that if you go to your homepage and it's a very investor-focused website, which is not that unusual, I'm guessing. But you say we just invented a whole new way to invest. Okay, introducing the first low-cost private market investment advisor. Can you explain what you mean by that?
Yeah. So if you have a normal investment advisor, maybe like a Betterment or Wealthfront or even Merrill Lynch, they're going to put you into stocks and bonds. That's how they allocate a normal investor's portfolio. Might be 70% stocks, 30% bonds, largely ETFs, mutual funds. Because of the way the markets work, you are not invested in any private assets. Mm-hmm. Because basically the definition of a private asset is the public can't invest in it. So it's been this barrier in the market that doesn't exist for institutional investors. So Yale, for example, actually has 75% of their investments in private market and 25% in public market. And the average investor who's institutional, like a hedge fund, private equity fund, pension funds, they're going to be doing at least 25% alternatives. A multifamily office, like some of the big ones, will definitely be heavily invested in private market assets. And the individual, until recently, just didn't have access to it. So we've created a way to give them access to it and do it in a simple and sort of guided approach that looks like how you invest in stocks and bonds, but puts you into an asset class that has historically outperformed stocks and bonds by a lot. Okay,
so that's sort of where you're basically making it easy to understand and simple for the investor, and that's where sort of the advisory piece, I guess, comes in.
We're technically a registered investment advisor. Right. So we are an advisor, and we try to create sort of these baskets for investors to get diversified, so they can add diversification to their portfolio, make a one-click, heavily diversified investment, and still get access to these generally higher return asset class that previously wasn't possible.
Mm-hmm. Mm-hmm. Right. So you mentioned earlier your e-REITs, and I want to dig into that a little bit. And full disclosure, I actually do invest in your income e-REIT. I have been now, I think, since soon after it came out. So it's almost a couple of years now. So tell us a little bit about the e-REITs, how they work, what kind of returns they're getting, and that sort of thing.
Yeah, so the way the e-REIT works is we we qualify a real estate investment trust with the SEC so that we can allow the public to invest in it. And then we, find or source real estate, in this case, debt, because the income E-REIT is focused on debt-like products. And we will source them and originate them and place them directly into the income REIT. So just to contrast that for a second, if you look at most REITs who are public, they gather their portfolio in the private markets. Maybe they'll gather a portfolio of a couple $100 million, and they'll take it public. And when they take it public, when you take a company public, you want to take it public at a higher price than you bought it. So normally you'll see companies price much higher. And then that's how normally an investor buys a REIT. So they buy a REIT sort of essentially retail rather than wholesale.
Mm-hmm.
And they pay a markup, and that markup the street will call liquidity premium. And if you're not going to sell that REIT, let's say you're a 5-year investment holder, then you're paying a premium, but you're not actually getting the value of it.
Right.
So we created these REITs that are like, we use electronic distribution to make it efficient. I mean, our upfront costs are like less than 1% now, and a typical, even an IPO is going to be 7-10%. And so we have a very efficient way to use technology to get access to, say, in this case, the income REIT's debt products, and that's why I think we have higher yield than you see normally in a REIT.
Mm-hmm. Mm-hmm. So, can you share what sort of the historical yield has been on the E-REITs?
Yeah, so the income REIT is a debt REIT, so that's been mostly so it's been at 10.5 or 11% since its inception. So it's blended probably somewhere between 10.5 and 11% annual current dividend. And then the other REITs are either equity REITs or hybrid debt and equity, and those are, I think, about an 8% dividend, maybe a little more, but they hold equity, so they're a decent amount of the upside is in the appreciation and the exit of the real estate. Mm-hmm. So that's, where does that end up? I mean, we obviously want it to be greater than income REIT, but it's as a highly regulated organization, we try not to make too many forward-looking projections here.
Sure, understood.
But historically, okay, sorry, you asked a historical question. Historically, it's on our site. I think in like a 12% return in like 14 and 15 and 16, it came down a little bit. I think it went down to a little less than 9 because we did a lot of equity investments, which pulled down our return a little bit because they have less upfront to payoff. Right.
Okay. So, can you give us some idea about the scale you're at today? Like how many, what sort of dollar volume of funds that have been deployed, or just give some idea about where you're at.
Mm-hmm. So we have invested in more than about $250 million of equity put out. We have about $1 billion plus of real estate. We have something like somewhere between 15 and 20,000 investors, 150,000 for users.
Mm-hmm. Okay, that is substantial. So I want to switch gears a little bit and talk about your equity fundraising, because not only did you take the hard road when you started the company, when you were doing property deals, you've also gone and done equity fundraising the Reg A plus way. I shouldn't say the hard way, but I guess it's a lot harder than raising money, privately. So tell us about you had a successful fundraise, I believe, in Q1 of this year. Can you tell us about your, how that process went and why you chose to go the Reg A plus route?
Mm-hmm. Well, so when we thought about raising another round, we did Series A back in 2014, and we started looking at doing a Series B. We basically came to the conclusion that our whole business is to allow the public, the individual, our user to access essentially this private, or previously sort of inaccessible type investment. And so the idea that or another way to think about it, we disintermediate sort of the private equity funds and a lot of the traditional Wall Street players. So, or investing pre-IPO is another way to think about it. So for us to have that be our business and our mission, and then turn around and raise venture money seemed a little bit incongruent. And so we started down that road. I mean, it took a little bit of time to get CC to qualify Rise Companies, which is our parent. But we basically said, let's take Fundrise itself public through the platform. Let only our investors invest. You can't just show up and just buy shares in the tech company. And so we did that. We started out by just saying, okay, well, who's interested? Can you just sort of we created a reservation list, and we ended up with something like almost 9,000 people on the list. And that's just from our investor base. And when we opened it, something like 2,000 people invested in less than 24 hours, and we got oversubscribed. And we had to reopen it again to basically get the, just to sort of handle the sort of unexpected demand. And so we ended up raising $15 million in that first that first go, but only really tapping a small part of our demand. So we sort of proved that this hypothesis again of creating an alternative approach to fundraising, an alternative approach to investing that I just think is the future of finance.
Right. Yeah. I mean, I think, there's been more and more Reg A Plus deals there. There's not as many, I don't think, as what people expected when they came in, but it's, I'm sure it gets easier the more people that do it. And I think it makes perfect sense to me that you would go out that way. You clearly have a customer base or an investor base, shall we say, that believes in you and is willing to, to add, invest in your equity as well as in your deals. So then I'm curious about what you're going to do as far as where you're going to take this company. Is this going to be, you're going to keep doing what you're doing? What's your vision for the future? I mean, you really have been a pioneer in so many ways. Are you going to continue to push the envelope in new areas, or are you just going to try and scale what you've got, or a bit of both?
I mean, I think that we're Blackstone in the internet age.
Okay.
So if Blackstone were to launch today, they would do it the way we're doing it. And they would focus, on a total tech solution. And so over 5 years, let's say, which is, say a midterm horizon, to me, raising money from pension funds, raising money from endowments, which is how every major private fund built their business, is yesterday's trend. And that the pension funds are a melting ice cube, that they are a consequence of the baby boomers retiring. And that's why there are so many pension funds. But as the baby boomers start to consume their retirement, the pension funds will start to shrink. Mm-hmm. And so, if you're 30 years old, you're not thinking about a pension fund. That's a joke, right? You're investing, you're managing your money online. Mm-hmm. And so that's where we're headed. That's where we put ourselves really well positioned to basically ride that trend. And we're going to keep innovating around giving investors access to really interesting investments in, we just launched a whole concept around housing for millennials in urban cities like LA and DC, for sale housing like townhomes and single family homes and condos, which are not REIT eligible. It's a whole different concept. So this is a mega trend, and I think it's going to be enormous.
Mm-hmm. So maybe one day in the distant future we'll see, Fundrise at a scale that Blackstone is at today. Then,
I mean, what you hope is that Blackstone looks at us and be like, it's kind of Walmart and Amazon, right?
Right.
I mean, it's Blackstone. I mean, it's like when I said to real estate developers they're at 325,000, they thought I was just joking, and now they come to me for money. I mean, It's the nonlinear nature of internet businesses always confounds and surprises the status quo players.
Right. Yep. No, there's many examples of that. Whether you go back to to the travel companies or Blockbuster, what have you. There's been many examples of that. Anyway, we're out of time, Ben. It was a fascinating conversation. I really appreciate you coming on the show today.
Yeah. Well, thanks for having me.
Okay. See ya. So to go through what Ben and his team at Fundrise have gone through, you've got to really be very passionate about the individual investor, and just you can tell, and just listening to Ben talk, that he really is passionate about that. And I think it's great because there really is so few opportunities for individual non-accredited investors outside sort of the stock and bond markets. If you want to invest in real estate and you're a non-accredited investor and you've just got a couple of $1,000s to invest, there really are not that many options for you. And Fundrise, having been a true pioneer in the space, I applaud them in doing that. I hope that we will see more companies go down this route of offering investments to non-accredited investors. I think it's really been a problem, I think, that the industry has suffered from. And I feel like companies like Fundrise are making it easier. They're blazing a trail, and I, for one, wish them all the best in expanding their business for non-accredited investors. Anyway, on that note, I will sign off. I very much appreciate you listening, and I will catch you next time. Bye. This episode was brought to you by Wonder Capital. Invest in solar energy projects across the United States. Earn up to 8.5% with a $1,000 minimum investment. Their CEO, Brian Bursick, was on the Lend Academy podcast just a few episodes ago, episode number 104. If you want to learn more, I encourage you to go to www.wondercapital.com/Lend Academy, and that's Wonder, WUNDER.